Hey everyone, we're going to talk about the new save plan today. As I do that, I'm going to make sure that I invite the rest of the crew here. So just give me a quick moment. All right. So that looks like it works. So I'm going to go ahead and send that out. Just 1 second. All right. So I think we'll have a few people joining here. If you wanted to put in the chat where you're joining us from today, just so I can make sure that you can hear me and we can test that'd be great. So in that chat there at the bottom, if you just wanted to put in where you're joining us from, well, we have people join us. You got somebody from Detroit. That's cool. New Mexico. Good crew. Kansas. Good. Southern Cal. Awesome. Awesome. So it seems like people can hear me okay. So today I thought we would just, make this casual, just try to go over a lot of the questions people have about the save plan, talk a little bit about the PSLF rule changes. I think we'll probably talk a little bit about just the IDR regulations. A lot of people are asking, can they undo this now? Like, could they take away plans because of what's going on with the the way Biden did these new IDR regulations? So I want to also make sure that I address your questions. So I thought, so if you're just joining us, by the way, some people are putting in the chat where they're joining us from today, if you wanted to throw that in there in the chat. So let's just start off by talking about what the save plan is. So the save plan is a replacement of the repay plan. This is the first time ever that we've seen a literal replacement of an existing income-driven repayment plan. So you might say, wait a second, how can Biden just replace an income-driven repayment plan? So there's two different types of income-driven plans. I don't want to go too into the weeds on this, but I just wanted folks to understand a little bit about how this plan got created and what's the risk that it could go away. So there's income contingent plans and there's income-based plans. So the income contingent plans are the ones that President Obama and President Biden have used to create new types of plans. The income-based repayment plan was literally defined by Congress. So Congress said, hey, this is going to be what the plan is. Basically, it's defined exactly in the law, whereas these other types of plans, Congress said that it's up to 25 years and up to 20% of income. So that's why the SAVE plan is going through this income contingent route, which is a route that's a lot less stable and secure than the income-based repayment route, which is a lot more secure because it's defined in the law. So one big thing that I wanted to make you aware of is, first of all, are you in this group that has options or not? So let's talk about a little bit about different types of groups that are affected by the SAVE plan. So first of all, people that borrowed before 2007. So you borrowed before 2007, you cannot do pay as you earn. And so your historical options were repay or income-based repayment, the old version of that, right? So the old income-based repayment plan, 15% of income, 25 years self-forgiveness, versus repay was filing jointly, and you did 10% of income, right? So if you borrowed before 2007, in most every case, you're going to be best off doing this new SAVE plan, pretty much, period. So the reason for that is because the SAVE plan is a bigger poverty line deduction at 225% instead of 150%. And the other reason is just a lower payment for the most part. 10% of income if your grad loans only, 5% if it's undergrad only, and then it's a mix between 5 and 10%, a weighted average if you have more than that. So if we think about, the people before 2007, is there a case where you would want to stick to the income-based plan? Yes, there is. So if you have a really low payment that was certified pre-pandemic, you might still be on the income-based plan, but you might want to hold off on that plan a little bit longer in case that plan is just, a better option for you to stick to temporarily. So one of the confusing things about these plans is there might be a better plan long-term for you that might not necessarily be the better plan short-term, if that makes any sense. So people pre-2007, you're deciding between income-based repayment and you're deciding between this SAVE plan, and probably I would say 80-90% of people are going to want to do that SAVE plan. So let's talk about the people between 2007 and 2014. So somebody, I think, just asked a question about that. So that's the date you first borrowed. So the dates that all matter here are when were you a new borrower for the first time. So if you're a new borrower as of 2007 to 2014, that means a couple things. It means that you cannot access the old version of income-based repayment, and it means that you can access the pay-as-you-earn repayment plan. Now, why does that matter, right? Remember we talked about the difference between the ICR plans and the IBR plans? So the IBR plans are written into the law, and that essentially gives you access to pay as you earn through IBR if you're a new borrower for the first time as of 2014. So if you're 2007 to 2014, then you're stuck with the old version of IBR or pay as you earn. And pay as you earn is under this this loophole side of the income contingent plans that Biden can kind of like change and play around with and change however he wants. So this is maybe a too complex way of saying, if you took out your first loan ever, if you went to undergrad or grad school and took your first loan out ever between 2007 and 2014, I would say that that is a little bit of a danger zone in terms of decision making, because you will no longer be able to access the pay as you earn plan, which is the first time they've ever blocked a plan after July 2024. So if you're already on the plan, you can stay on the pay as you earn plan. Now, the reason why this is like a danger zone here is because you cannot get access to that 20-year plan on new IBR because you're barred from it if you borrowed for the first time between 2007 and 2014. So this is like this. I would fall into this group, for example, right? Like I went to undergrad in the started in the late 2000s, right? So it's like a lot of people in their call it like early to mid 30s to like mid 20s. That's kind of like the group of people that this falls under. That's a big group of borrowers. It's a lot of borrowers in that group, right? So what I would kind of recommend as a catch-all suggestion to people that are in this group is, if you're on the pay plan, just wait. Like, don't hop off of this plan just yet. We don't, unless you've had a consult with us or some group like that, right? The reason is because if you get off of the pay plan and you borrowed for the first time between 2014 or 2007 and 2014, then when you lose it forever. So you cannot get back onto the pay plan when you leave it if you are in this group that borrowed for the first time between 2007 and 2014. So if you're going for forgiveness, the difference in payments is fairly modest. So you kind of have to do some calculations if you're in this group. So if you're in this 2007 to 2014 group that started college around that time, then what you want to think about is, could I benefit from a payment cap? Pay has caps and save plan does not have caps. Could I benefit from 20 years or 25 years till forgiveness? That's a big calculation. Um, you want to think through, do I care about the interest subsidies or not? You might not care about the interest subsidies. These are really important kind of considerations to run on the pay versus save discussion. Now, the other thing is maybe you're not on the pay plan yet. Maybe you're on repay or something like that. Well, now you have to run the math between, should you get onto pay before the deadline? That's an interesting conversation. I would say this primarily probably impacts, like, I'll give a couple examples, like lawyers, attorneys, I would say dentists, veterinarians, maybe pharmacists in a lot of cases. So basically people who have very high earning years in their like late 40s and 50s, basically would want to avoid making those 5 extra years of payments if at all possible. So like a 20-year plan is of great value to a dentist or veterinarian who has an exponentially increasing income, compared to somebody who's a more stable income. It's just going to be getting inflation level raises. So that there's a lot of math behind this like pay versus save calculation, and it's I think pretty complex. And I will talk about Parent Plus loans. Someone's asking about Parent Plus loans. I promise I'll get into that. So I just wanted to kind of talk first about how save impacts 3 distinct groups of borrowers. If you're just joining us, people before 2007 that took out loans for the first time, people that took out their first loan between 2007 and 2014 who have to make this pay versus save analysis. And then there's a group that's new borrowers after 2014, which is the new IBR plan versus the save plan. So this is a little bit more secure. If you're in that group, maybe you could come out on that new repay plan and get some interest subsidies. And then, you could do the save plan for the interest subsidies for like a couple of years or a few years, and then switch on to the new IBR plan, because the new IBR plan is guaranteed to you in the statute of the law. So that's a big deal. The difference between the plan being created from an executive order and literally being there in the law. So the group after 2014 has a little bit longer window to decide if you took out your first loan after 2014, just because you're eligible for something that the Biden administration cannot take away without they're trying to take it away, but they can't really take it away because it's in the law. So you have a little bit more time to decide on that. Um, so for folks just joining us here, I want to talk a little bit about the PSLF regulations, and I want to talk a little bit about the IDR switching regulations and the recertification dates. And then I'm going to try to go through as many of your questions as possible. We'll also talk about Parent Plus. Actually, I'll just talk about Parent Plus right now. So Parent Plus loans, it's really very unfortunate what the Biden administration decided to do on Parent Plus loans, in my opinion. So basically, what happened is, if you are doing a new consolidation after July 2025, that consolidation would not be eligible for the double consolidation loophole, where Parent Plus borrowers mash up a bunch of loans together to create something that's eligible for the save and the pay as you earn plan in most cases. So what does that mean? If you have kids that are already graduated from school, it means you got to get into high gear to get this double consolidation completed before that date, well before that date. And the stakes are extremely high, right? Because the deduction that you can get for the save plans, 225% of the poverty line, ICR is 100% of the poverty line. So that's a huge difference, right? So like for a family of two, for example, I think that's about a $44,000 deduction on save versus about a $20,000 deduction on the ICR plan. And on top of that, you're having to pay 20% of that amount above that on ICR and only 5 to 10% on the save plan. So that's a huge difference. Now, what happens if you have have kids in school right now? What we're kind of telling people is try to finish your Parent Plus borrowing by January 2025, and if at all possible, to give yourself enough time to get those loans double consolidated. Now, if you're not able to do that, if you're not able to, if you're still going to have kids in school after 2025, you're going to have to decide what makes the most sense based on your financial picture. So somebody makes, $200,000, $300,000 a year, then you might need to take private loans for the marginal extra borrowing if the loan amount is like fairly modest. If you are going to be making a very modest income anyway, then you might still want to take out all Parent Plus loans, but just understand that your payment is going to be not nearly as good as it has been historically. So the Parent Plus situations are really fraught with complexity, but just know that we're good and for the next 2 years, and then we're going to have to get all those double consolidations completed by July of 2025, or else we're going to not have the ability to help clients get access to that. So I want to talk about the PSLF regulations real quick. So PSLF regulations specifically, a lot of people qualify now that didn't used to. So like, for example, Kaiser Permanente physicians used to not qualify because they were employed by a for-profit group that worked at the hospital that was a not-for-profit. And so they came out with new regulations basically saying, now if you work in a job that by state law tells you you can't be directly employed by the not-for-profit, essentially what you're supposed to do is apply, but put the not-for-profit employer's employer identification tax number on your employer certification form. So we just had somebody literally like this last week that said they applied before that July 1st date when the regulations changed, and he got denied, and he thought he didn't need to apply anymore because he wasn't eligible. That's not true. So these PSLF regulations, and this is more broadly, everybody should just throw an application at the wall and see what happens now that it's post July 1st with a lot of these rules changing. So let's talk a little bit about the income-driven repayment restrictions and regulations surrounding switching different repayment plans. So if you are on the IDR plan, if you're not on any IDR plan, right, you can only get on to pay as you earn until July 2024. So this has never happened before where they've blocked somebody from signing up for a plan that is in their promissory note. I've got a lot of concerns about this. They were very much adamantly trying to simplify the student loan IDR plan options to people. That's why they imposed these restrictions, because they didn't want people to have multiple different options. They wanted to try to make it simple. I think they just probably opened up a Pandora's box long term, because what this means is, maybe a future, maybe different ideological views president could block different plans that are not, allowed to borrowers in the law. So that's one thing that people should be comfortable about, is income-based repayment is literally defined in the law. So if you're in the new IBR program, you're safe, because the new IBR program is literally defined in the law. The old IBR program is also defined in the law. Everything else besides that is up in the air. Now, one argument the Biden administration would make is they don't have to worry about lawsuits because they're making everybody better off. That's actually not true in some rare cases, and most people are much better off on the save plan than the repay plan. And they also let people stay on the pay plan if they're already on it. So they're trying to minimize legal challenges to their plan, which makes sense. But it does open up some real risk because, yes, there's absolutely a chance that SAVE could get curtailed significantly in the future. What I've been telling people is 2026 is probably the soonest date that any kind of changes could happen to undo the SAVE plan, unless there's a legal challenge before then. I don't think that would be successful. But 2026 is the soonest we think that the SAVE plan could be clawed back if you don't see a successful legal challenge within the next couple months. And then the next date that you'd have to worry about it would be in 2030. And the reason for that is basically, I think probably if President Biden or Trump were to win, I don't think that they would mess with the SAVE plan regulations. I mean, if you look historically, President Trump didn't really care about student loans and student loan policy. So I don't think that necessarily that would be a target of his. And so that's why I say I think that would mean that the first rulemaking committee that would make new rules about it, IBR plans, would be in the 2028 presidential election, which means they couldn't implement them before 2030. And if whoever wins in 2024, they would not be able to implement new regulations before 2026. So that's why I think SAVE plan's mostly safe unless you see a big lawsuit against it in the next couple of months. So let's see. I'm going to now look at some of your questions, and I appreciate you letting me get through sort of the initial part of that. And I'm going to probably just try to answer people's questions until my voice gives out. So a couple people asked about like Parent Plus loans. So the answer is really yes. The Parent Plus loans need to get double consolidated. If you have any amount of Parent Plus loans at all, there's no downside other than your time. And if you need to hire a group like us, a few $100s of cost to get these loans figured out to be double consolidated. So you should do this because why not? You don't know what the future is going to hold. It would be nice to have that optionality, even if you don't end up needing it, right? Let's see. So some people are asking about, what if I have only a couple of loans? So if you only have a couple of loans, like a Parent Plus and a consolidation, you need enough to do 2 consolidations, right? To be honest, we're wondering if the regulations prohibit a triple consolidation based on the way they're currently written. You could probably figure out a way to do a triple consolidation. That's like really technical and specific. So we're going to see if there's ways around these rules. We don't know if there's going to be. Right now, we don't think that there is, but there could be. So if you have loans that you want to get access to the SAVE plan for, basically you've got to borrow them before January 2025 to give us enough time to double consolidate them, because you can't do it with 2 loans. You've got to have more than that to do double consolidation loophole. So is there an instance where the SAVE plan exceeds the interest, and does the payment excess go to the interest? So think about like the way they're designing this plan, right? So take everything you know about the repay plan and just make the subsidy better, and just, think through how that plan would work with SAVE. So what I mean by that is, let's say your required payment is $100 a month, but you've got $1,000 of interest that's accumulating every month, right? So under the repay plan, the way they would have done it is all of the remaining interest, which is 1,000 minus $100, it's $900, right? Repay, they would have subsidized half of that unless the other half accrue onto your balance. The SAVE plan is going to cover all 900 of that, though, the remaining interest. So you still get charged for the interest that your required payment represents. And let's say that your required payment is more than $1,000 a month, then they're going to pay, essentially they would cover, that would cover all of your interest. And then yes, anything above that level first would apply towards accrued interest. That's the way they've always done it. And you might say, well, how would there be any accrued interest left over? So keep in mind, they're also changing the way they do interest capitalization. So if you do not consolidate your loans after school, then that interest is just going to be sitting in an accrued interest bucket. So if you make a payment that's over and above that 1,000 a month that you have to, it's probably going to be applied towards the interest, right? So the accrued interest will get paid down first, and then any excess that you have would be applied towards principal. Several people are asking about when are they going to require recertification for IDR plans. So recertification, I think, is going to happen basically no sooner than February 2024. I think that part hasn't changed. If your recertification date falls before then, I think it gets kicked out a year. So most people will not be recertifying until 2024. That's the reality. Most people will not need to recertify until mid to late 2024. There are some people that will even not need to recertify until 2025, I think. So the simple strategy is, if you are not working with us or the professional, right, then you would just say, like, is my payment really low? Do I have to recertify? If no, then don't recertify and keep the low payment. Now, there's some significant reasons why you would want to recertify early. I'll give you an example. I have a friend who literally got married and had 3 children during the student loan pause. And he last recertified when he was a single individual making about the same amount of money. He makes a little bit more now. But the vast, vast increase, the large increase of his family size from 1 to 5 means that his deduction for the save plan now would be about $78,000 or $79,000. So effectively, his payment, if he recertifies, would be dropping from about 200 or 300 a month to 0 because his family size is larger and gets a much bigger deduction. And in that case, even though his income's gone up, he would save a lot more money by recertifying early to get that payment recalculated to a much lower level, and he'd save a bunch of money on interest. So that's just an example of, some people do need to recertify early, some people don't. Here's another example. So say you're on the pay plan and you have $100 or $200 a month payments, and this could also be true for income-based repayment. And let's say you maybe made those recertified payments when you were in training, like as a resident or something like that. Now you're making a lot more money, but you're not on the save plan or repay slash save, right? So you might say, oh boy, I better switch on to the save plan. But that would be a huge mistake because maybe your payments go from $200 a month to $2,000 a month a whole year earlier than what they needed to, just because you switched plans, so you have to recertify. So that's not a good deal at all. So some people will want to certify, will want to change their income based payment early and recertify their income based payment early. And some people will. And the other thing I'd emphasize is the save plan is good for, might be good long term for some people, but it might not be the right choice short term for you, right? There's the long term strategy, and then there's the tactics, right? The tactics are, when do you change? What plan do you switch to? When do you make that change, right? So there's a lot of big savings that can happen around these decisions right now. And I think that we've got one of our team members too putting links in the comments. Yeah, definitely. I'd put the booking link here. I'll put it in the booking link in case somebody knows that they need to talk about this, but while I answer some more questions. That's our booking link. If anybody needs to book a consult or a follow-up consult, I'll get some more questions here. Let's see. So a couple people are asking if I'm on the repay plan and I switch to save, or they put me on save against my will or something, does that reset my payment count? No, it doesn't. So they keep all that good stuff that you're used to. Basically all the historical payments you made on your old loans, old payment plans, that all carries forward. The only restriction is if you have 5 years worth of payments on the save plan, starting July 2024, you will not be able to switch out of that plan after you made 5 years worth of payments on it. So what does that mean? It means that the soonest you could be locked in forever to the save plan would be July of 2029. So that's something interesting to note. I do have, like I said, big concerns about people leaving the pay plan and leaving new IBR if you know it's the right plan for you to get 20 years forgiveness, because I do think that there's definitely a risk of a future Republican president sort of using the rules the way Biden did to say, hey, you've already made your 5 years of payments on save, so now we're going to lock you into the plan. And oh, by the way, we're also going to amend the terms of this plan to make it the original repay rules where you can't file separately, you have higher payments, 25 years until forgiveness. That's a real risk here. I have to be real honest with you. It's a real risk that they're going to change the rules and sort of dare people to file a lawsuit, and they will. But if the composition of the court isn't different by that point, then you could see a scenario where they say, well, President Biden made the changes, so a Republican president can make changes. So the one thing that I'm very confident in is they cannot make changes based off what's in the statute. So let's talk about PSLF, right? PSLF is in the statute. There are things that they could do to push PSLF benefits away a little bit and restrict those benefits a little bit, but they couldn't completely repeal PSLF. They couldn't say, oh, you can't, get PSLF if you're working at a 501c3 hospital, right? They can't do that because it's written into law. Same thing with the new IBR plan. They could not eliminate that plan completely because it's written into the law. The only thing that they could do, and the thing that they would likely do, is they might take that new save plan and just eliminate it and put everybody back on repay. So essentially, the worst case scenario, I think, is literally they take away everything that Biden's giving borrowers by creating save and replacing the old repay with save and just literally reversing that. And the soonest, again, that could happen would be 2026, maybe 2030, depending on how the election goes. So now I'm going to get to some more questions. So far, my throat's still holding out. Um, so let's see. Some people are asking about retroactive credit. So, can you buy back prior periods of deferment and forbearance? And is that possible? So, right now, I think that it's going to be only possible to do that for future periods, like after the regulation changes. So, if you were to do a forbearance or deferment in the future, that's a discretionary one, and you want to buy that credit back in the future, I think you'll be able to. I think, unfortunately, that in the looking backwards, I don't think that we're able going to change that looking backwards. I don't think there's going to be any kind of retroactive removal of forbearance or deferment outside of the period during COVID. So the one thing I'll say is during the COVID forbearance, from March 2020 till today, basically almost anything is possible if you try hard enough. The reason I say that is because, like, in school deferments, we've seen those removed if they were during this COVID forbearance era. The problem is if you try to remove those from before the 2020 era, the problem with that is it essentially puts your loans into a defaulted status, and that messes up everything. So you don't want to do that. So I would say if you have a bunch of deferment and forbearance before the pandemic, your best bet, instead of worrying about a buyout clause, it's probably not going to ever happen, is to just focus on like getting IDR waiver credit. So if you take advantage of the IDR waiver, you can have forbearance at least 12 months consecutive or 36 months total. You can get all that credit added to your forgiveness programs. And so that's what I would really be focused on. And you can actually even file an appeal too, saying that you felt like you were steered into forbearance if you don't quite meet that 12 months and 36 months test for the IDR account adjustment. And you can also consolidate loans and get all that forbearance and deferment credit added on to your balance credit for forgiveness as well. So there's just a ton of tools out there, and you got to use the right tool, right? It's kind of like you're doing a construction job. You want to use I don't know, if you need a flathead, you use that instead of the Phillips screwdriver, right? It's kind of like that. You want to make sure that you use the right plan. So some people are saying, what about, let's see, what some people are saying, what about the save good for PSLF? Yes, it's very good for PSLF. The one time it's not good for PSLF is if your calculated payment is going to be higher than the capped payment because you're making a lot of money. So the most common example of this would be a physician. You make your 200, 300 a month payments during training, and your payment soars. So how would this be applied in practice? Like, say you have a physician who's in training making 60,000 a year with 100,000 of student loan debt, and let's say that physician is paying the 300 a month in training, and then they become an attending, make 300,000 a year, but they have 100,000 of debt. If they were on like the IBR or the pay plan, the payment would get capped at about 1% of the principal balance, so it's about 1,000 a month. But if they did the save plan, their payment might be like 2,000, 2,500 a month, give or take. And so that's way more money, and suddenly you're not able to get loan forgiveness. So again, like most things in student loan land, unfortunately, this is very complicated, right? There's a for most people, this is the answer question, but it's not like in every scenario. It very rarely is, just because again these rules are quite complicated. Some people are asking, what about is there a chance that recertifications get kicked down the road further? I don't think it's a very good chance. I think that they just want to try to get this thing just moving again, because there's going to be such a high level of voluntary forbearances that people are doing. I think that's the other thing, is they really just, let's be honest, I think they wanted to make sure there wasn't a mass wave of defaults right before the presidential election. That's the real reason for this 12-month on ramp, and it's because they think it's the right thing to do. But I think it's mostly too because you don't want to see a really bad like wave of defaults happen all at once right before the presidential election. That would not be a good thing. That would not be popular with voters, right? So that's one of the reasons that they're just basically this forbearance, by the way, would not count towards forgiveness. It does not pause interest. This is just the same thing, really. It's just a discretionary forbearance that servicers have always granted to borrowers who call and ask. So I do think that there's going to be a lot of uses for this forbearance. Like if your payment would be much lower on the save plan, maybe you're an undergrad borrower and you're having to wait until July 2024 before that 5% payment option is available. You might strategically use that 12 months of forbearance to not make any payments because your payment's about to go down a whole lot. So some other people are saying, should we be consolidating our FFEL loans right now? Absolutely, you should be. You should be consolidating them with everything that you have. In most cases, there's a couple rare cases where the answer is not to do that, but in most cases, yes. And remember the IDR account adjustment. You've got a limitation of basically December of this year that it's over. So anybody that wants to get all their stuff added back, they're not going to be able to do that. You're not going to be able to get all your deferment forbearance credit added, after this IDR waiver account adjustment's over, especially FFEL borrowers. Got to consolidate if you haven't already looked into that. Let's see. So we're going to say, do you have to wait until filing taxes to be able to update your income for the married filing separately loopholes? So I'll say that's a case-by-case basis. Some people would want to recertify early if they filed 2022 separate, because you might be able to get your payment much lower on an already existing plan you certified. Some people will strategically want to wait to file their taxes in 2023 separate, and that'll happen obviously in early 2024 when you make that decision. I will say way more people need to file taxes separately than used to. So I'm going to give you a couple examples just to try to illustrate this, right? So let's say you've got a family of 5, 2 people each making $80,000 a year, right? You would think that this is, and let's say they each have 30,000 of student loans, okay? So joint family income of 160,000, joint student loan balance of 60. Now you might say this is definitely a group of people that need to pay back their loans, right? No way can they get forgiveness. And the old way of doing things, yes, that was true. But the new way, it's totally not true. And I'll give you an example why. So each of them are making 80,000 a year. And so their deduction, if they file jointly, is based on a family size of 5. And so you look up what that is. 225% of the poverty line for a family size of 5 is about $79,000 off the top of my head. And so they would be able to deduct 80 out of their 160 combined income, and they'd have to pay, if they have undergrad only debt, 5% of the amount above that level, right? So they'd pay 5% of 80,000 because that's the extra amount they have. But if they filed taxes separately, now they each use a family size of 5 minus 1. So each of them gets a family size of 4. So they basically each get to claim the kids, right? And so family size of 4, 225% of the poverty line is about 66,000. So if they make 80 minus 66 is about $14,000, right? So if you take 5% of $14,000, I think that's about $700. I'm just doing this, doing this live here, folks, right? So it's about $60 a month. So $60 a month, $700 a month of payments. So you just do some quick math. What's $700 times 20 years, right? It's about $14,000. That's way less than 30,000. Now, let's say that they each decided to save the maximum for retirement. Let's say they each put in the max into their 401ks. Well, that gets their income below 66,000. So now both of them have not only a payment of $0 a month, they also have interest of $0 a month. So you have zero interest, zero payments. And in fact, what this really creates is married filing separately can sometimes create an indirect retirement match on your retirement accounts because of how the new math works. It's really crazy because think about the old repay plan, right? The old repay plan required you to file a joint, and there was a 50% subsidy of unpaid interest. But now you're having 100% subsidy of unpaid interest, and they also are allowing people to file taxes separately. Now, I think that they very unlikely tried to coordinate those benefits, but this is a massive planning opportunity for people that are unaware of it, right? So filing separately is going to be a lot more important than it's ever been. And I think that you're going to see maybe 3 to 4 million people, maybe going from that amount of filing separately to maybe like 10 million people filing taxes separately because of these benefits for the SAVE plan. And this is probably more beneficial for somebody that might actually eventually pay off their loans to get the subsidy, but maybe not. Maybe it's a better way to get forgiveness too. And keep in mind, if you're worried about the SAVE plan going away, you shouldn't be, because the simple truth is, if you're getting a 0% interest rate because you're getting subsidies, or maybe you're getting 1 or 2 or 3% interest effective rate, then your actual opportunity set for for what you're losing is not that much, right? You lose forgiveness, but you've got 0% interest while you've been putting money in 5% yielding money market funds at a minimum. So this is why this is such a huge opportunity. Let's see. So some people are asking, can you consolidate undergrad and grad without any new loans? Yeah. So I'm unclear about that question, but basically sometimes there's consolidated subsidized and consolidated unsubsidized. One of the problems that I see is they're going to, at least the way I read the rules, any consolidation loans are going to be tagged with a 10% of income payment, regardless of the mix of undergrad and grad. That's not good. Like if ideally you would have it be based on the weighted average. Now, what I think this is going to mean is if you're a dentist or veterinarian or physician or something, a lawyer, where the vast majority of your debt's grad school, that doesn't really matter. You're talking 10% of income versus 9.5. Like that's not that big of a deal. The benefits of consolidating right away after graduation are probably bigger because you get to enter that save plan right away. And I think that, um, I mean, it's like, when do you decide to consolidate or not? Now, this used to be a slam dunk. Everybody always consolidate, but the new rules, let's say you have like half undergrad, half grad school loans, it might be better to not consolidate those so that they don't get tagged with the 10% of income amount, so that you get the weighted average. So you get, 7.5% of income instead. It could make a big difference. Um, so some people are asking, does ICR still work when you file separately? Yes, it does, as long as you're enrolled in it before 2025. If you're not enrolled in it by 2025, it's going to be too late to get on it later, unless you're on a Parent Plus loan, then it would be available. So let's see if there's some more questions here. Let's see. People are asking about PSLF. It used to be at least 30 hours a week between two jobs. It's now just straight up 30 hours. That's also a big change. Yeah. So if you are just 30 hours, that's all you need. I would say that there's also some ways to get around employers that are being difficult and don't want to sign. It's sort of a case by case basis, but the PSLF rules, essentially what they're trying to do is just make absolutely everybody that you could humanly think could qualify for PSLF to qualify for it. So you definitely want to throw your hat in the ring. Studentaid.gov/PSLF is where you need to go to submit your ECF form if you're not already doing that. So ICR, someone's saying it's 20% of income, or it's a 12-year payment, lesser of the two, correct? Yes and no. So the 12-year is not just a straight up 12-year, because think about it like this. If it was just a straight up 12-year term, no one would do the capped payment on IBR and pay, right? Because standard 10-year is going to be a higher payment than a 12-year amortization. What they really do is it's a income adjusted 12-year. So they calculate the 12-year amortization on the ICR, and then they literally multiply it by a factor based on your income, which I think can go up to 2.5. So then it turns into almost like a 6-year, So it's just like, I will say that some of this stuff's like the most complicated stuff ever. Like, you're like, did they like sit in a room and just like take shots of, gin and tonic until they could think about what was the most complicated plan that they could create known to man? That's kind of how the ICR plan feels like just to me sometimes. So we're getting some more questions about, let's see, can I get 0 a month payments if I haven't started work in September? Yeah, you can. That's one of the big benefits of consolidating, is you can use that old, income before, which is 0 if you filed your tax return last year, and then you're able to certify that and get that 0 a month payment with 0 interest for a whole year. It's a big deal. Now, the downside of that is, it used to be there was no downside. Now the downside is this. So the interest capitalization rules are different now. It used to be that your interest was going to capitalize no matter what. That means your interest that was accrued during school gets added to your principal balance. You still owe it either way. The only difference is that interest literally gets compounded into your balance and generates more interest. So it used to be that since your interest would capitalize no matter what you do, it doesn't matter because it's going to happen anyway. So you might as well consolidate. Now, if you don't consolidate, from what we're reading, the interest is not going to get added into the principal balance. So now you have to decide between consolidating and getting the interest added in, or not consolidating and having your payment start a little bit later, and then having that interest not capitalized and be added to your principal balance. So super, super confusing. I mean, it's like they're trying to make it simpler, but in so doing, they're making it harder. And so let's see. A couple people are asking about, some people are saying, I've got 200K of Parent Plus loans, I've got 100,000 of income. Should I try to pay it off? No. Parent Plus borrowers really need to do this double consolidation. Everybody needs to do it. Everybody needs to just do it with whatever they can do it with. The other thing I would say is, say you have some more borrowing to do with kids like about to go to school or finishing up, it's not that big of a deal to have an extra 50,000 of loans that are private that you're paying back, and you've got 200,000 or 300,000 Parent Plus that's on a save plan where you're paying almost nothing, right? So you get rid of the private loans, and then you're not having to deal with. You might say, why would I go private? Well, remember that Parent Plus loans, if you just look at the interest rates, are pretty awful, right? There's like 8% interest, a upfront fee of like 4.25% for financing charges. Parent Plus loans absolutely are terrible on the face of them. It's only these plans like the save plan, double consolidation stuff that can help you. Now, some people are asking about the double consolidation. What does that mean? It's just something that applies to Parent Plus borrowers specifically. So the reason is Parent Plus borrowers, the only borrowers blocked from doing the save plan directly. So the way you get around that is there's a loophole where in the statute it says that you can't access it through a consolidation of Parent Plus loans. But what it doesn't say is you can't access it through a consolidation of Parent Plus loans. And so think about, you have 4 Parent Plus loans. You take the four Parent Plus loans. I'll do this fingers here if I can do that. 4 Parent Plus loans. You split it into two, right? Well, you split it into 2 different consolidation loans that you put it together for one consolidation. That's how you do it. So that's like the double consolidated and non-Parent Plus loan with a previously consolidated Parent Plus loan to activate the loophole. Yeah, if you have a consolidation loan and you have like an unsubsidized Stafford loan, you should be able to combine those 2 and get the loophole. For people with different numbers of Parent Plus loans, it depends. I better not get too far ahead of myself too, because like our consultants are much better at Parent Plus consultations than I am. So the ones you want to talk to more so than me. So now I just want to open it up to questions for the last like 10 minutes or so. Basically, if you just wanted to put in whatever is on your mind. The other thing I will say is our team of consultants, I'm biased, of course, but I really think they're the absolute best in the world at doing this. And so if you do need a custom plan, studentloanplanner.com/book. I'll put that in the chat so you can click that. So a couple things I think are going to happen in terms of the way that this is all going to work out. So I think that what we're going to have is the wave of folks like realizing all these benefits between now and like September. So the next 2 months is going to be people realizing like how all these benefits impact them, right? And people that are planning ahead type of people. And probably if you watched a YouTube live about IDR regulations, you're a plan ahead kind of a person. And so we're going to have that wave of people that's going to be meeting with us like proactively. And then we're going to have the people that wait, and the people that wait are going to start thinking about it when their interest starts getting charged in like September or October. And so October will come around, people will get their first payments. And then there'll be 2 months left in the year, November and December, where you've got to take action for things like the IDR waiver and getting the deferment forbearance credit and all those sort of things. And so then I think it's going to be a mad rush to try to get all that stuff implemented in time. And then you're in 2024, but those first 6 months of the year are going to be a mad rush of people who borrowed for the first time between 2007 and 2014, trying to figure out if they need to sign up for pay at the last second or not. And so definitely try to not wait until the last second to get some of these benefits, because they're really enormous, I think. So let's see some more questions here. Could you use SAVE as a strategy to pay off loans more quickly with less interest? So that's a great thought. The problem is eventually you run out of subsidies. So let me explain what I mean by that. So let's say you got 100,000 of loans and your required payment for the first year out is 0. So the way the repay plan works is that the subsidy is applied no matter what, even if you pay extra over what you owe. We think SAVE will be the exact same thing. So if you pay a way extra on the SAVE plan, then all your payments will be applied to either accrued interest or principal, whatever is applicable in your case. And you'll pay that. All your extra payments in that first year is going to go straight to principal. It'll feel great, right? So maybe you pay your 100,000 down to 80,000, and then you recertify the next year, and your required payments 100 a month, and you're still getting almost 0 interest, and all your extra payments are going to paying down principal. So now you pay down 80 down to like 60, right? So the problem now is, let's say in year 3, that's the first time you have a true income-based payment based off of your entire year, calendar year income. So maybe now your required payment's 500 a month. Well, you pay down your balance. So now you have 60,000 instead of 100,000. And let's say the interest now that you have to pay is like $4,000 a year instead of what it was when you had 100,000, right? So now you have a $4,000 a year interest amount, and you've got, 500 a month required payments. At that point, you're not getting an interest subsidy anymore. So there's no real benefit to keeping loans federal unless you're just going to gamble that there's going to be another student loan pause. There could be, but I think that that's probably quite unlikely with the current composition of Congress and just the experience of, I think, really, I mean, that's why they're creating the SAVE plan, to be honest, is like the Democratic Party's position is sort of like, this is what's going to be generous enough to help people be able to make payments. And they're also creating stuff where if you're in default, it's going to like force you onto an income-based plan. So you're not going to be able to stay in default as easily long-term unless you just really actively try to not give income information. So they're going to be actively trying to get people out of default with a lot of these new regulation changes. And they're going to cure all prior like defaults on your record. So it's really a big deal, what they're doing with that. So I don't think we'll see another student loan pause, at least for another 10, 20 years, unless there's something horrific that happens. I sure hope that's not the case, but like, war, natural disaster, something like that. I think would be the only reasons that they would, do a new student loan pause. Um, so let's see. Some people are asking about tax treatment of forgiven loans. So remember that also ends in 2025. Like the no taxes on forgiven student loan balances. I think that they're going to hold that in their back pocket. If you're the Republican Party, you're going to hold that in your back pocket until you want to bring that out in a negotiation to try to rein in the generosity of some of these programs, right? So let's say that if Democrats hold the presidency, the Senate, and the House, then they would, be able to extend that forgiveness tax treatment another 5 years, right? Because, or say 5 or 6 years. If they don't have one of those chambers, though, Republicans probably would not agree to that change unless they got something in return. So that could be something like capping Parent Plus loans, capping Grad Plus loans, making Save a little bit less generous and codifying it. I mean, this is really them playing the long game in Washington, right? They're trying to implement their preferred policies and try to make them so sticky that they're really hard to undo. And so, that's also why the Republicans don't want to give up on the tax bomb, because I think it's just a bargaining chip. I also don't think that they want to charge it. That's why we've always advised borrowers, we don't think the tax bomb is going to happen. We think it's very, very unlikely because, Democrats and Republicans both like winning elections. And so you have to think like the second level, which is like, what's the strategies behind all of this and what is likely to happen based off political realities, right? So some folks are saying Save is better regardless of whether you file separate or joint, isn't it? And that's actually not the case. So keep in mind this: if you are a grad borrower, Save is 25 years, Pay and New IBR are 20. If you look at the difference in the monthly payments, the Pay and New IBR payments are about $100 a month more than the Save plan. So it's about $100 a month difference. So that's not a big difference in the grand scheme of things. If you're, let's say, you're making 100,000 or 200,000 a year, 100 a month difference between the plans is not that much. Now, let's say I'm just going to use dentists as an example because they have typical like sort of exponential type of incomes a lot higher in the end of their career, right? So what is the value of shaving off 5 years of payments at $3,000 a month? Would you trade that for paying 100 a month extra along the way? The answer probably should be yes, right? You'd rather give up those last 5 years of payments where you're making, 3,000 a month payments that are super high in exchange for making a little bit higher payments along the way. And so a lot of people are actually going to want to stay on Pay and New IBR, even though there's no interest subsidies, because what's more important is the overall payments. Since it's very, very unlikely that the tax bomb is going to happen, the priority needs to be on minimizing payments. And so that's something that is really important to think about because, you want to be thinking like, how do I keep my payments as low as possible? There's also other things to factor in, like, again, like which plans are like guaranteed to me in the law, which plans are not guaranteed to me in the law. So you can be able to make backup plans for yourself personally as to, what you should be doing in terms of going for, forgiveness or not. So one person says, how does the IDR impact PSLF once payments resume? So remember that any of the IDR plans count, and so you want to go with the ones that's the cheapest for you. And so a lot of people will not realize this, but that's why you want to wait to sign up for an income-driven plan. Wait to sign up for Save if you need to do that. You might want to wait because your current IDR certification might be way cheaper than switching. So that's a big reason why people need to like double check the math. Some people asked about signing up for it. Studentaid.gov/IDR. I'll put that in the chat. Studentaid.gov/IDR. I'm going to try to spell it right. So that's where you can sign up for the current version of that is the repay plan. The repay plan is turning into the Save plan. So if you're on repay or want to sign up for Save, you could probably sign up for repay now. I will say this: the Biden administration claims they're going to have a sign up form for Save that's going to be coming out before payments restart. We'll see when and if that happens. But that's technically the way to do it is to go to the student aid website and sign up for repay, which will become Save. Now, again, don't do this if you're on Pay, if you're on a new IBR, possibly even if you're on old IBR because of you potentially having a better payment or a better strategy overall, or not being able to access Pay in the future ever again. So a couple other people, I'll end this in the next few minutes, but a couple other people asked what kind of things do you lose by filing taxes separately? You lose mainly things that affect you in niche cases. So, for example, you'll lose a lot of the subsidies for the ACA plans for health insurance. That's a really big one. You're not able to do married filing separately sorry, you're not able to do Roth IRA contributions without doing a backdoor Roth anymore. Um, let's see. I think earned income tax credits another thing that impacts people that do married filing separately. There's quite a bit. Also, and the other big impact is if you have a really different income from your spouse. If your spouse makes 400,000 a year, you make 50,000 a year, your taxes for filing separately would be way, way higher than filing jointly. So there are some pretty good reasons why you want to file jointly. Maybe even if you have student loans, it just depends on if the benefit of the taxes is better than the savings on the student loans or vice versa. When you switch from pay to save, will interest capitalize? The good news now is no, it won't. According to the Biden administration, I don't know what that means what the servicers will do. The servicers I could see doing anything because they don't have any money to implement any of this stuff. So theoretically, it's not supposed to capitalize. The only time it definitely capitalizes is when you leave the IBR plan. So when you leave the IBR plan, it's in the statute that it has to capitalize. Also, when you consolidate, it capitalizes. So a couple people are also asking about pay stubs. Can you recertify on pay stubs instead of tax returns? No. Well, yes and no. No is the general answer. You need to use tax returns. What some people will do is they will submit pay stubs that show like a strategically low income and try to get a whole year's worth of payments certified on that. We suggest aggressive stuff, but we don't want to also get too aggressive, right? We want to operate within the rules. Our loopholes need to be well within the rules. Nothing crazy. Nothing that's trying to. We don't want to get anybody in any kind of trouble, right? So to me, you always want to use tax returns if at all possible, unless you have a very clear reason for using pay stubs. That's not like you trying to show a really low pay stub without a bonus to get a lower payment, because that's against the rules, right? The full-time PSLF rule change. So basically, most people don't realize this, but most of all these big changes about PSLF and interest capitalization and all the different types of deferment forbearance counting, that all is already in effect in July 1st, 2023. The SAVE regulations technically go into effect July 30th of 2023. The 5% of income calculation, that's not going into effect until July 2024. So that's the main thing that's not going to go into effect until July 2024 is the undergrad benefit of 5% of income instead of 10. I could probably answer questions all day here. So some people are saying I'm on certain plans. I got a notification saying interest capitalization can't happen. So don't believe absolutes, right? Like whenever somebody tells you something that's absolute, like ask them like, where does it say that in the law or the statute? And if they can't tell you that, they probably don't know what they're talking about, right? I'll say that that what they did is they eliminated interest capitalization for all events that it's not statutorily required. And so there's plenty of places where it is statutorily required, like leaving the IBR plan. And then when you consolidate, you're creating a new loan. So that's one of the reasons it capitalizes. Remember too, a lot of times people worry about interest capitalization. I would never worry about that. I would worry more about your long-term strategy. Interest capitalization usually doesn't affect people that much because at worst, you're talking a little bit of interest on interest. But remember, if your payment's really low because of SAVE, you're getting all that interest subsidized anyway, right? And if you refinance your loans eventually because you're paying your loans off, you're going to be getting that interest capitalized when you leave the program anyway, right? So there's not really any big secret to saving a ton of money by avoiding interest capitalization. The way you save money is by getting the married filing separate, right? Getting the save versus pay versus new IBR versus old IBR decision right, by doing that double consolidation on time, by not leaving your currently certified income-based payment early when you don't need to keep your payment as low as possible, by updating your income information when it's strategic and smart for you to do so, by again, filing your taxes the right way. If you live in like California or just Texas or like a community property state where you split the income 50-50, there are a ton of different scenarios out there. And also, interest rates are much higher than they were earlier a couple of years ago. So that math is also different. It's much harder to justify refinancing now, although it's still very possible compared to what it was a couple of years ago. So the last thing I'll leave with everybody here, our social media team will try to answer as many questions as we can. But remember that nothing replaces the getting a custom plan based on your circumstances. So getting a custom plan based on your circumstances is very, very likely going to pay for itself. If you think about our reviews, I think we have like 2,300 5-star reviews now. We're like 4.96 out of 5 stars on those reviews. People love our student loan advice because we're kind of student loan nerd weirdos, and that's all we do. We love it. And so we're really good at this one narrow thing. And so I would, very much feel honored if you used our free stuff like our podcast and our email list to attempt to figure it out yourself. But there's a very real risk that you will cost yourself 10x or more of our consult fee by trying to do it yourself and then making a mistake. Not in every case, of course, but there's a significant risk. That's why I would start with just getting a custom plan. And if you're already a client, then I might consider getting a follow-up plan, especially if you haven't gotten one in the past year since we've been able to model all these save plans. And yeah, thanks for some of the people saying the stop being cheap people get, it's worth it. Thanks for the person who said that. It's funny. But yeah, I mean, it's obviously something people prefer to not spend money if you versus spend money. Obviously we get that, like, but it's just, again, the reason you do something is because it's going to save you a lot of money compared to what you would do otherwise, right? Like, so somebody says, how do you get a custom plan? Again, just I would say just go to studentloanplanner.com/book. So studentloanplanner.com/book. So if you go to that link, you should be able to schedule with a member of our team. And some folks said shout out to Ben, who's been helping out on the chat today. It looks like a little bit. So thank you, Ben, for helping out. So yeah, we look forward to helping you, and we look forward to helping you guys just come up with a solid plan for repayments restarting and to minimize your stress, minimize your anxiety. And again, thank you so much. And we'll try to do another one of these. This one's pretty popular, had several hundred people on for the whole hour. So that's pretty cool. So thank you for joining today, and we'll have a lot more content to help support you with repayments restarting to make this a non-stressful thing for you and your family. Thanks for listening.